You see, most men in this game don't lose because they lack intelligence. They lose because they lack timing and timing. Now, that's a different sort of education. It isn't written in books, and it doesn't shout at you from the tape. It whispers. And if you're not patient, you'll miss it entirely. Tell me, how often have you felt the urge to act just because the market was moving? Not because you understood it, but because it was alive and you didn't want to be left behind? That's the first mistake. The market doesn't reward activity. It rewards patience. There were days I made my biggest gains by doing nothing at all, just sitting, watching, waiting, because the money isn't made in the thinking or the clicking. It's made in the waiting. A man must learn that there is a time to be in the market and a time to be out of it, and those two times are not equal. Most of the time, you ought to be out. Does that surprise you? It shouldn't. The market spends more time confusing people than it does rewarding them. When conditions are unclear, when price drifts without purpose, that's not your signal to act. That's your signal to stay out. Now think about this. When a stock, or any market, begins to move with purpose, what does it do? It doesn't hesitate. It doesn't stutter. It moves clean, almost as if it knows where it's going. That's the kind of movement a trader must wait for. Not noise. Not guessing. Certainty in motion. You don't predict that move. You recognize it. And here's where most go wrong. They anticipate instead of confirm. They enter before the move has proven itself. Why? Because they fear missing out. But let me ask you this. What's worse, missing a move, or being wrong in one? When you enter too early, you're not trading. You're hoping. And hope, in this business, is expensive. Timing is not about being first. It's about being right. When I watched the tape, I wasn't looking for excitement. I was looking for behavior, repetition, patterns. A stock that acts right, rises on strength, pulls back lightly, holds its ground. That's a stock under accumulation. That's information. But if you jump in before that behavior becomes clear, you're gambling, not trading. So what should you do? You wait for confirmation. You wait for the market to show its hand. And when it does, you act without hesitation. That's the paradox, you see. Long periods of patience, followed by decisive action. Most traders reverse that. They act too often and hesitate when it matters. Have you ever noticed how the best trades feel almost obvious after they've already started? That's no accident. A proper move leaves footprints. Volume expands. Price breaks clean levels. There's no confusion. And yet, many traders ignore those signs because they're too busy chasing earlier, uncertain moves. Now consider cause and effect. When a trader enters too early, what follows? Doubt. Small fluctuations feel like threats. He exits too soon or holds too long out of fear. But when a trader enters at the right time, after confirmation, what follows is clarity. The trade behaves as expected. Confidence builds. Decisions become easier. Timing, then, is not just about entry. It shapes your entire experience in the trade. And exits. Now that's another matter tied closely to timing. A man must know when the move has run its course. Not by guessing, but by observing. When momentum slows, when the market stops rewarding continuation, that's information. The same patience you use to enter must guide your exit. Let me ask you, do you exit because the market tells you to, or because you feel something? If it's the latter, you're not following the rule. The market leads. You follow. Always. There's also the matter of waiting between trades. Most traders can't do it. They feel idle, unproductive. But I tell you, the market pays for discipline, not activity. If you trade every day, you're forcing opportunities that don't exist. And when you do that, the market takes its payment from your account. The real professional knows that capital is ammunition. You don't fire it at shadows. You wait for a clear target. Now, let's bring this down to something practical. What should you actually look for? First, a clear trend. Not a guess, a visible direction. Second, strength in movement. Price moving with conviction, not hesitation. Third, confirmation. Breakouts holding, pullbacks respecting levels. When these elements align, timing presents itself. And what should you avoid? Choppy markets. Sudden spikes without follow-through. Trades based on prediction rather than observation. If you find yourself asking, maybe it will. you're already on the wrong path. The market doesn't deal in maybes. It deals in what is. There's also a mental shift that must occur. You must stop thinking in terms of constant opportunity and start thinking in terms of selective precision. One good trade, taken at the right time, can outweigh dozens of poor ones, but only if you have the discipline to wait for it. You see, wealth in trading isn't built through speed. It's built through alignment, being in sync with the market's rhythm, and that rhythm is not constant. It ebbs and flows. Sometimes it offers nothing. Sometimes it offers everything. The question is, can you tell the difference? Because when you learn to recognize those moments, those rare, clean opportunities, you begin to understand what timing really is. It's not a trick. It's not a secret. It's a skill born from observation, patience, and restraint. And once you see it clearly, once you feel the difference between forcing a trade and waiting for one, you start to realize that the market has always been showing you the right moment. You just weren't ready to wait for it. Timing begins where impatience ends. That's not a clever phrase, it's a rule, and the market enforces it without mercy. You see, impatience is what drives most traders into the wrong trades. It's that quiet pressure that builds when nothing is happening. The chart looks still, the price moves sideways, and a man begins to feel he should be doing something. Let me ask you, doing something for what purpose? Because the market demands it, or because your mind cannot tolerate waiting? The truth is, impatience creates action where no opportunity exists. A trader begins to anticipate instead of observe. He tells himself, this might break out, or this could reverse, and the moment he says, might, or could, he has already stepped away from certainty and into speculation. That's where losses are born, not from bad luck, but from acting before the market has made its intentions clear. Now consider what happens when you remove impatience, when you truly accept that most of the time nothing needs to be done. The noise of the market starts to fade. You begin to notice the difference between random movement and purposeful movement. You stop reacting, and you start observing. Have you ever watched a market long enough to see how it prepares before a real move? It doesn't rush. It builds. It tests levels. It shows its strength quietly before it shows it loudly. But an impatient trader never sees this. He's already in and out, chasing shadows, mistaking motion for meaning. When impatience is gone, timing becomes visible. You start to wait for confirmation, not because someone told you to, but because you've seen what happens when you don't. You've seen how early entries lead to doubt, how small pullbacks shake you out, how trades that haven't proven themselves rarely reward you. And slowly, you begin to understand that the market must invite you in. You cannot force your way into it. Think about cause and effect here. When you act out of impatience, what follows? You enter without clarity, and so every tick feels uncertain. You watch the price too closely. You question your decision, and eventually you either exit too soon or hold too long. But when you wait, when you let the market confirm your idea, what follows is entirely different. The trade aligns with your expectation. The movement supports your position. Your decisions become simpler because the market is working with you, not against you. That's the power of timing. And yet, most traders resist it. Why? Because waiting feels like doing nothing, and doing nothing feels like missing out. But let me ask you, what is it you're really missing? Opportunity, or just activity? There's a difference, and it's a costly one. The professional understands that opportunities are not constant. They are selective. Rare even, and that's precisely why they're valuable. If good trades were everywhere, no one would lose money. But they're not. They appear only when conditions align. When price, volume, and behavior all tell the same story. Your job is not to create that story. Your job is to recognize it. So what should you do in practice? You watch. You wait for structure. You look for clean movement, not choppy noise. You wait for levels to break and hold, not just break. You let the market prove itself before you commit your capital. And when it does, when everything lines up, you act without hesitation because your patience has already done the hard work. Impatience, on the other hand, is expensive. It leads you into trades that haven't earned your money. It keeps you active when you should be still. It convinces you that being in the market is better than being right, but the market doesn't reward presence. It rewards precision, and precision only comes to the trader who has learned to sit quietly, to observe without interference, and to trust that the right moment will reveal itself, not to the fastest but to the most patient. A trade entered too early is a trade built on hope, and hope, in this business, has no foundation. It doesn't come from the market, it comes from within you. And that's exactly the problem. You see, when a man enters a trade too early, he is not following evidence. He is following expectation. He sees what he wants to happen, not what is actually happening. Let me ask you, how many times have you looked at a chart and convinced yourself a move was about to begin, even though nothing had truly confirmed it? That's hope at work. The market, on the other hand, deals only in facts. Price either moves with strength or it doesn't. Levels either break and hold or they fail. There is no almost in the tape, but the impatient trader lives in that almost. He acts before the signal is clear, believing he's getting ahead of the move. But getting ahead of the move often means getting ahead of the truth. Now consider what follows when you enter early. The trade hasn't proven itself yet, so naturally, it behaves unpredictably. Small movements against you feel larger than they are. You begin to question your position. Was it the right entry? Should you exit now? And before long, you are no longer trading the market. You are managing your own emotions. That's the cost of hope. On the other hand, when a trade is entered at the right time, after confirmation, the experience is entirely different. The market moves in your favor with purpose. Pullbacks are controlled, not chaotic. You don't feel the need to second, guess every tick, because the trade has already shown its strength before you entered. Do you see the difference? One is built on assumption, the other is built on evidence. Hope also distorts risk. When a trader enters too early, he often justifies staying in the trade longer than he should. He tells himself, it will turn, or it just needs time. But that's not discipline, that's attachment. And attachment to a losing position is one of the fastest ways to lose capital. When you rely on hope, you lose your objectivity. The professional avoids this entirely by waiting. He doesn't guess where the market will go. He waits to see where it is going. He allows price to confirm direction, to show strength, to establish structure. Only then does he act, not before. And this requires restraint, because the market will tempt you. It will move slightly, just enough to make you think the move has begun. It will test your patience. It will make you feel like you're missing something. But that feeling, that urge, is exactly what you must learn to ignore. Because a real move doesn't need to be chased. It reveals itself clearly. Think about cause and effect again. When you build a trade on hope, what follows? Uncertainty, emotional decisions, inconsistent results. But when you build a trade on confirmation, what follows? Clarity, control, and a higher probability of success. So what should you look for instead of hope? You look for proof, strong movement, clean breaks, continuation after entry points. You want the market to show commitment before you commit your money. Anything less is not a signal, it's a suggestion, and suggestions don't pay. You must train yourself to recognize the difference between a potential setup and a confirmed opportunity. Most setups never become opportunities. They remain ideas that never materialize, and that's fine, because your job is not to trade every idea. Your job is to trade the ones that prove themselves. Let the others go. There is no penalty for missing a trade, but there is a cost for entering one without evidence. Every premature entry chips away at your capital, and more importantly, at your confidence. Over time, this builds a pattern of doubt and inconsistency that is far more damaging than any single loss. And it all begins with hope. A trader must learn to replace hope with observation, expectation with confirmation, and impulse with discipline. Because the market does not reward what you believe. It rewards what you can see clearly, act on decisively, and manage without emotion. Clear price behavior is your only signal. Nothing else matters. Not opinions, not predictions, not what someone else thinks the market should do. The market speaks through price, and if you're not listening to that, you're not listening at all. You see, many traders clutter their minds with noise. News, indicators, rumors, forecasts. They pile it all on, hoping something will give them certainty. But let me ask you, has any of that ever moved the market? Or does the market move first and everything else follows? Price comes first. Always. When you look at a chart, your job is not to interpret stories. Your job is to observe behavior. Is the price moving with strength, or is it hesitating? Is it respecting levels or breaking them cleanly? Is it trending with consistency or drifting without direction? These are not opinions. They are facts, visible to anyone willing to look without bias. But most don't look. They assume. A trader who ignores clear price behavior often finds himself confused. He enters a trade based on an idea, but the price does something else. And instead of accepting that the market is telling him he's wrong, he holds on. He justifies. He waits. Why? Because he trusts his opinion more than the evidence in front of him. That's a costly mistake. Clear price behavior removes doubt. When a market is strong, it shows it. It moves upward with conviction, pulls back lightly, and continues. There's rhythm to it, structure. You don't have to guess, you can see it. And when a market is weak, it behaves the same way in the opposite direction. Lower highs, failed rallies, steady pressure downward. Now ask yourself, do you trade what you see, or what you think? Because the difference between those two is the difference between consistency and confusion. When you rely on anything other than price, you introduce conflict. Indicators might say one thing, news might say another, and your emotions say something else entirely, but price has no conflict. It is the final result of all those forces combined. It is the truth of the market in its simplest form. And simplicity in trading is power. Let's consider cause and effect. When a trader focuses on clear price behavior, what follows? His decisions become cleaner. He knows when a trade is working and when it isn't. He exits without hesitation when the behavior changes. There is no argument, no debate, just observation and response. But when a trader ignores price and follows opinions, what follows? Hesitation. Doubt, late exits, early entries. Because opinions can be defended but price cannot, it either confirms your position or it doesn't. That's why the professional strips everything down to the essentials. He watches how price reacts at key levels. He observes how it behaves after breakouts. Does it continue, or does it fail? Does volume support the move, or does it fade? These are the questions that matter, not what the market might do, but what it is doing. And here's something worth understanding. Clear price behavior is not constant. There are times when the market is messy, unclear, difficult to read. During those times, the best decision is no decision at all. Because if the signal isn't clear, then there is no signal. Why trade confusion? The disciplined trader waits for clarity. He knows that when the market is ready, it will show itself. And when it does, there will be no need to force anything. The opportunity will be visible, almost obvious, because the behavior will align. Price, structure, momentum, all telling the same story. That's when you act. Until then, you observe. You train your eye to recognize clean movement, to distinguish between noise and intention. You stop reacting to every tick and start focusing on meaningful shifts. Because not every movement matters, but the right ones do. The best moves feel obvious only after they've begun. That's the irony of the market. When the opportunity is still forming, it feels uncertain, unclear, even uncomfortable. But once it starts moving with conviction, once price begins to travel cleanly in one direction, everyone suddenly sees it. And by then, most are either too late or too hesitant. Now let me ask you, why does that happen? Why does clarity come after the move, not before it? Because the market doesn't reveal its intentions all at once. It unfolds them. At first, there are signs, subtle ones. A level holds where it shouldn't. A breakout attempts to form. Volume increases slightly. But these are not confirmations yet. They are only hints. And the impatient trader mistakes those hints for certainty. He enters early, hoping the move will follow through. But the experienced trader waits. He understands that a real move must prove itself. It must break cleanly, hold its ground, and continue. Not hesitate, not reverse, not trap. When those elements align, the move begins to look obvious. And that's precisely when it becomes tradable. You see, obvious in trading does not mean easy. It means confirmed. Most traders have it backward. They believe they must get in before the move becomes obvious, as if being early is the key to profit. But let's think about that. When you are early, what do you actually have? No confirmation, no structure, no guarantee that the move will continue. You are relying on prediction, not evidence, and prediction is fragile. Now consider the alternative. When the move has already begun, when price has broken out, held above a level and started to trend, what do you have then? You have proof. The market has shown its hand. It has committed to a direction. And while you may not catch the very beginning, you are entering into strength, not guessing into uncertainty. Which one sounds more reliable to you? There's also a psychological shift that occurs here. When you enter too early, you feel pressure. Every small movement against you feels like danger. You watch the trade too closely. You react emotionally. But when you enter after the move has begun, after it has proven itself, you feel something different. You feel alignment. The market is moving with you, not against you. That difference changes everything. Let's look at cause and effect. Enter early, and you invite doubt, hesitation, and inconsistent results. Wait for the move to become clear, and you invite confidence, structure, and follow through. The outcome is not random. It is a direct result of your timing. And yet, many traders struggle with this because of one simple fear: missing out. They see the move start, and instead of recognizing it as confirmation, they see it as something they've already missed. They hesitate, thinking the opportunity is gone. But that's not how strong moves work. Real trends don't end the moment they begin. They develop. They extend. They offer multiple opportunities, if you're patient enough to recognize them. The key is not to catch the entire move. The key is to catch the right part of it. You don't need the first tick. You need the confirmed direction. So what should you look for? Clean breakouts that hold above resistance or below support. Strong candles with follow-through. Pullbacks that respect the new structure instead of collapsing back into the range. These are the signs that the move is not just starting. It is continuing. And continuation is where the money is made. You must train yourself to become comfortable with entering after the move has already shown strength. It may feel like you're late at first, but in reality, you're right on time, because the market is no longer asking a question. It is giving an answer. Most of the time, the correct position is no position. That's a hard truth for many to accept, because it goes against the instinct to always be involved. A man sits in front of the market, watches price move, and feels he must act. But tell me, since when did movement alone become an opportunity? The market is always moving, but it is not always offering. You see, there are long stretches where price does nothing of importance. It drifts, it chops, it moves up and down without direction, without conviction. And yet, this is where most traders lose their money. Not in strong trends, not in clear breakouts, but in these quiet, confusing periods where nothing is truly happening. Why? Because they refuse to stay out. There's a kind of pressure that builds when you're not in a trade. It whispers to you. It says you're missing something, that you should be doing more, and before long, you start seeing setups that aren't really there. You convince yourself that a move is forming, that this time it will be different. But let me ask you, how often has that turned out well? When you trade in a market that lacks clarity, you're not following signals. You're forcing them. You enter without conviction, and the market responds with uncertainty. Price moves against you, then back in your favor, then against you again. There's no structure, no rhythm, just noise, and noise is expensive. Now consider the opposite. When you choose to stay out during these periods, what happens? At first, it feels uncomfortable. You question yourself. You wonder if you're being too cautious. But then, as you continue to observe, you begin to see the difference between a quiet market and a ready one. You start to recognize when price is building towards something meaningful, and when it isn't. That's where discipline begins to pay. Most traders think discipline means controlling losses or following rules inside a trade. But real discipline starts before the trade. It's the ability to do nothing when nothing should be done. to sit still while others are chasing every movement, to protect your capital not just from losses, but from unnecessary exposure, because every trade carries risk, even the good ones. Let's think in terms of cause and effect. When you trade constantly, what follows? Overexposure, emotional fatigue, a series of small, inconsistent results that slowly erode your account. But when you trade selectively, only when conditions are clear, what follows is focus, confidence, higher quality decisions. The difference isn't in skill, it's in restraint. A professional trader doesn't measure his success by how often he trades. He measures it by how well he chooses his moments. He understands that capital is limited and every position must be earned by the market. Not imagined, not forced, earned. So what should you look for before taking a position? Clarity, direction, clean price behavior. If those elements are missing, then the opportunity is missing. It's as simple as that. And what should you avoid? Markets that are sideways, erratic, or unpredictable. Situations where price cannot hold a level, where breakouts fail quickly, where movement lacks follow-through. These are not environments for profit, they are environments for preservation. Sometimes the best trade is the one you never take, but that requires a shift in thinking. You must stop associating action with progress. In trading, progress often comes from inaction, from waiting, from observing without interference, because while you are sitting out, the market is revealing itself. It is showing you what works and what doesn't, where strength lies and where it fades. And when the right moment finally arrives, when price begins to move with purpose, you will see it clearly. Not because you chased it, but because you waited for it. Confirmation is strength, anticipation is weakness. That's not theory. It's something the market proves over and over again to anyone willing to pay attention. You see, anticipation feels smart. It gives a trader the illusion of being ahead of the crowd. He looks at a chart and says, "This is about to break," or "This is going to reverse." And for a moment it feels like insight. But let me ask you, what is that belief based on? Evidence or expectation? Because the market does not reward what you think will happen. It rewards what actually happens. When you anticipate, you enter before the market has committed. Price hasn't broken the level. The trend hasn't established itself. The move hasn't proven its strength. You are stepping in before the facts are in place. And when you do that, you place yourself in a position where anything can happen, because nothing has been confirmed. That's where weakness begins. Now consider confirmation. It is slower, yes. It requires patience. It asks you to wait while the market shows its hand. But when confirmation arrives, it brings clarity with it. A level breaks cleanly. Price holds above it. Momentum follows through. There is no guessing. You can see the strength, and strength is what you trade. Have you ever noticed how trades based on confirmation feel different? There's less tension, less second guessing. The market behaves in a way that supports your position. That's not luck, that's alignment. You waited for the market to prove itself, and now you're moving with it, not against it. But when you anticipate, the experience is entirely different. You enter early, and immediately you are tested. Price hesitates. It pulls back. It moves in ways that make you question your decision. And now you're stuck. Not because the trade is bad, but because it was premature. That's the cost of weakness. Let's look at cause and effect clearly. When you anticipate, what follows? Uncertainty, emotional reactions, inconsistent results. You are constantly adjusting, reacting, defending your position. But when you wait for confirmation, what follows? Structure, confidence, a cleaner path forward. The outcome is shaped by the timing of your decision. Now, many traders resist confirmation because they believe it means being late. They think the move has already happened. But let me ask you, if a move is real, if it has true strength behind it, does it end the moment it begins? Or does it continue offering opportunity to those who recognize it? Strong moves persist. Weak moves fail quickly. So when you wait for confirmation, you are not missing the move. You are filtering out the weak ones. You are avoiding the traps, the false starts, the moments where the market teases direction but delivers none. You are choosing quality over quantity. And that's where consistency is built. What should you look for in confirmation? breakouts that hold, not just touch and reverse, price that continues after entry, not stalls, pullbacks that respect structure, not collapse through it. These are signs that the market is committed, and commitment is what gives your trade its strength. Anything less is uncertainty. You must train yourself to become comfortable with waiting for that proof. It may feel slow at first. It may feel like you're letting opportunities pass. But over time, you begin to see the difference. You begin to notice how many anticipated trades fail, and how the confirmed ones behave differently. That awareness sharpens your judgment, because in the end, the market is not testing your intelligence. It is testing your discipline. It is asking whether you can wait for what is real, or whether you will act on what is imagined. Bad timing creates emotional trading. Good timing creates clarity.